Our bull, David Katz, Matrix Asset Advisors Chief Investment Officer. Our bear, Keith Springer, Capital Financial Advisory Services President. Keith, I'll start with you. Can this rally hold? Does it have legs?
It has legs for a short amount of time, but not for a long period of time. The problem is there's no aggregate demand. There's just not simply aggregate demand in the economy. You need more jobs, you need consumer spending, you need housing prices to increase, and it's just not possible with what we have. It's not that today or tomorrow the market won't rally. In fact, I think it has legs for a couple of weeks. I'm really fearful of GDP. I don't think the consumer is spending on big-ticket items, the things that are necessary to drive the economy for a long period of time. I think by July 27th, when GDP comes out, it's going to be a lot worse than expected. And I think at that point, you've seen the government continuously downplay GDP. We started at 3.5, then we went to 3.0, now we're at 2.7. If it comes in less than 2.5, 2.0, you could see a catastrophe on the market, and that's what I'm afraid of, and that's what I think we're in store for, and that's what I want to prepare for coming up.
All right, David Katz, I've known you for a long time. You're usually a glass is half full kind of guy. What do you think?
We see all of those macro concerns, and there are a lot of things out there, whether it's Europe, whether it's our economy slowing down. But the bottom line is right now you're able to buy some great businesses at 10 and 11 times earnings. The market in aggregate is selling at about 12 times earnings. Historically, if you take the last 20 or 30 years, when you can buy very good businesses at 11, 12 times earnings, you're going to make very good money. Turn the volume down, have a 12 to 18-month time horizon. We think you do very well with your money. We actually think the market ends up 10, 11% from the year, which means from here you have a very significant rally in the back half.
Keith, why can't you identify the feedback loops as being all negative and all going downwards? At some point, they have to move positive anyway. Why can your downward feedbacks not change more rapidly than you assume? Why can we not have a turnaround in consumer confidence, say, that rallies everything else, that changes CEOs' decisions on hiring and investments?
Because, Simon, what you're looking at is a rational situation in an irrational world. The market is very irrational at the turns. It's very rational during normal periods of time, but at the turns, when an economy turns in one direction or the other, it's very dramatic moves. 2 years ago, we had a slowdown. The market overreacted in one way. Then we had the market starting to come back, and the economy looked like it was going to come back, and the market overreacted strongly the other way. So the market is very irrational at the turns, and any large disappointment...
Forgive me for interrupting you. Forgive me. The economy isn't necessarily turning, is it? What's happening is that it is slowing. There is a deceleration in the growth. It hasn't actually deteriorated.
Well, you've got it right. You hit it right on the head. It's a sort of what I call a slog through the mud economy. And a slog through the mud economy is not what bull markets are made. And it's not that we have to have tremendous growth, but anemic growth is not going to be enough to move stock prices forward. And any disappointment is going to dramatically hurt because this market has a lot of growth built into it. It's just not possible.
So would you short? Would you actually go as far as... would you short the market?
I would short as we get close to the GDP, yes. I would absolutely short. I'm not completely out of the market now. I think we're in for a rally for a couple of weeks until GDP. I think we were largely oversold. But as we get close to GDP, the minute-by-minute sales numbers, the consumer is not spending on peak-ticket items. Okay. It's not buying durable goods. It's not buying the things that needed in the economy. It's buying books and iPads and iPhones, but not enough to drive this economy strongly forward. And as we get close to GDP, I really think you're going to see a major disappointment, and at that point, I would want to be short.
Okay, guys, thank you. David and Keith, thank you very much.
Thanks.
Appreciate you sharing
your
ideas with us.